llevar en torno a unos 9 meses de duración aproximadamente. Y nosotros, mientras, vamos a preguntar por todo esto a James Athey, Investment Director en abrdn. James, good afternoon. Thank you so much for having us.
Good afternoon.
James, inflation cooled more than expected in October in the US, positive surprise, of course, for equity markets and for the Federal Reserve. What do you expect now about the Federal Reserve?
Yeah, absolutely. I think you can see from the reaction of equities that absolutely that is a relief to them to some degree. The idea has been that the biggest risk to equity markets is the Fed, and while that's true indirectly, you have to consider the fact that policy is still going to be tight at least through the first half of next year, and therefore the economy is likely to weaken further from here. So while it's good news for equities in the short term, and I'm sure they will run with this reaction, I think there are still concerns ahead, and I still think that ultimately we'll see equities make a new low. What does it mean for the Fed? In and of itself, not a lot. I think it confirms that they will hike 50 basis points in December, although we should note we have one more CPI print between now and then. Unless that's a big upside, I would expect 50 bips in December, and then it's all about the data, the labour market data, the inflation data. That will tell us just what to expect from the Fed, but I certainly think they will assume that they are tightening early next year.
Look at what it's saying Mary Daly from Federal Reserve. She says it is appropriate to consider stepping down on rate hikes. What do you think about it?
Yeah, that's basically what they told us at the recent meeting. They managed that. What the Fed is really worried about here is celebrating too soon. Essentially, they don't want to celebrate the decline in inflation at an early stage, and in doing so allow a serious easing of financial conditions, which could well reboost economic activity and begin to create further inflationary pressure. So they don't want the market to get too carried away at this very early stage. By the middle of next year, inflation is likely to be much lower, and at that point they would probably welcome an easing of financial conditions. But if they allow that to happen now, then it could become self-defeating. So I think we will continue to see Fed speak confirming that a down step from 75 bips is the base case, but I also think they will be cautioning markets that there is still work to be done. They still expect to be hiking beyond December.
And what can we expect about the next monetary policy meeting in December? Because we are seeing how the possibility of a 50 basis point rate hike is skyrocketing, this possibility right now. Do you see this race for December, or can we expect some surprises?
No, yeah, our base case, they didn't. The decision to communicate at the recent meeting that they were expecting to hike by smaller increments in the future is not one that they will have taken lightly. I think by communicating that to markets, they were essentially placing the burden of proof on higher inflationary pressure. And what we've seen obviously here is a miss versus consensus, so even lower than a consensus which was already lower than prior numbers. So from the Fed's perspective, I think that rubber stamps the idea that it's right and proper to be hiking by less than 75 basis points. So I expect 50 at the next meeting, absent, again, a massive upside in CPI next month.
And taking into account, considering the raises we are seeing in Wall Street, is celebrating the inflation data, what can we expect now on equity markets for this last part of the year?
Well, I think they will run with this reaction for a while. There's probably not sufficiently important data for a couple of weeks that might give equity markets a negative shock. So I think we're likely to see them performing well in the coming days and weeks, because this is potentially a significant inflection in this monetary tightening cycle. But again, at the moment, equity markets in the US contain what look to me to be much too high earnings expectations for 2023. And indeed, they have a price earnings multiple, which is above the long-term average, which when you're about to go into recession, as we think the US is, doesn't make a great deal of sense. So I would still call this a bear market rally. It's one that's likely to run, but ultimately I expect equity markets to make a new low sometime in the next 2 or 3 months.
And James, last question. Can we talk about a peak on inflation and core inflation?
Yeah, so core, ordinarily economists think that core is an indicator of where headline inflation will be in the future. I think when inflation has been driven by global cost shocks, as we have seen in this episode, the opposite is true. Headline is the leading indicator for core. And so the fact that we've seen really now 3 or 4 months of declining headline, and indeed pandemic affected components have been falling fairly considerably, I think all of that is an indication that in the coming months we will continue to see core inflation decline, and ultimately when shelter components catch up to the real-time data, I think that core decline will start to be more significant.
James, Athey, thank you so much. It's been a pleasure.
My pleasure. Thank you.
Nosotros nos quedamos con estas claves. Por cierto, que ya tenemos el